Well, log in one morning, and on the left-hand side, I see all these big VC names right in front of me, and I can just click on them. And all of a sudden, I have a different dashboard set up right in front of me.
Hmm.
And it kind of looks similar. Like there's little differences, like different times. So instead of maybe 21-day moving average with a 7-day, it was maybe an 8, and with a 13 or something, like a fib crossover setup. And I was like, okay, all right, interesting. There's some takeaways here that I can learn and use for my own knowledge. But for the most part, I'm looking at the right thing in my mind. I was like, all right, finally on to something. And then just later that day, I go on Twitter and I see one of those VCs just going all poetic on Twitter with this massive long thread and hitting on some of these stats. And I'm like, oh God, that's what I'm looking at. And I no, that's not right. And it was like, oh man, this to me was like, am I in a vaporware industry? This was like my existential crisis moment because I thought I finally had something. And I'm looking at their stuff right that morning, and eventually they found there was a bug and they closed it off, and that was that. But then afterwards, I see that tweet, and I'm like, I kind of say it was like I found out that the emperor was standing there naked. So it was that moment where I kind of got really worried that I was completely in this industry that was just total, essentially BS, selling vaporware, and it's almost like people knew it was vaporware and they were just trying to sell vaporware to each other.
Ben Lilly is managing partner and head of research at Jlabs Digital. He's published almost 1,000 essays and posts on crypto and macro at large. He's been in the space for a decade in various capacities: retail investor, angel investor, professional research analyst, builder, consultant, founder, rugged, hacked, creditor, and bankruptcy. What he's most proud of is creating his own way of thinking about tokens in terms of its fundamentals. He's called it the quality theory of tokens. It's a view that he hopes to get into the market in order to try to help founders better understand how to use tokens to build economies around their ideas. And we're going to get into the journey that started today. So Ben, welcome to XC Interviews. You're the very first guest. How are you today?
I'm doing great. I'm excited to get started here and knock it off.
Okay. Well, my first question is a tough one. Why is tokenomics a 4-letter word?
That's a good one. And just quick background, it's kind of funny in a Discord chat that we have. If anybody uses the word tokenomics, they actually get banned from the chat for like a minute or two. Just at this point, it's not just a joke with the team, but in all seriousness, tokenomics, it just, when someone's using it, it's clearly a crutch. And the crutch is that they're trying to say allocation tables, or what is the distribution going to look like? What's the vesting setup for these tokens? What is the supply growth of the tokens over time? So if anybody's using the word tokenomics, I'm like, hey, what do you mean by that? Just kind of unpack it, because there's a more specific word that you could use. Otherwise, you would just talk about economics at large. So that's the background on that.
I was going to say, Ben being a little bit of that word Nazi. I'm laughing because I think I was referencing someone else use it and I got banned, or that post got banned on Discord. And I thought, my gosh, this guy's serious. But I'm really excited today to talk a little bit about this idea of token ratings. You and I met many years ago at this point, I believe. And I think this was one of the first discussions that we had. It was kind of the beginnings of it. And then it's matured into what you're doing today. There's going to be a lot that we're going to unpack today. I'm going to give my idea, what I think the big idea is. And then I'm looking for you to kind of develop it here, because I think there's, as I said, there's just a lot to discuss. So when I think about token ratings, it's thinking of crypto protocols as economic information networks that allow you to fix the failures of 99% of crypto projects that fail and determine what will prosper. And then looking at that from a price perspective. And I know there's a lot to discuss there. Just a couple other notes I had here. It's looking at historic approaches for modeling protocol prices that look at technical analysis or fundamentals, or even token supply and emissions, what some people will probably call tokenomics. And you have all these elements, and they're all part of the story, but they're not the complete story. And you believe that by layering them together, as you've started to do with the token rating system, analysts can isolate the properties that drive price movements for a token. And importantly, and this is the real key element, uncover the factors that driving price to that would prevent so many of these projects that fail today. So many of the rug pulls, or maybe it's not even the rug pulls. These are really the projects that intend to do something meaningful, but don't know how to do it. So, Ben, is that a good description of this big idea?
It is. It's a lot there, and I think to distill it down a little bit, it's just a way to think about a token, a project, your users. There's really I like to think of it as three legs of a stool, and if you kind of neglect one, then the stool won't work. And that is the network side of things, that is the monetary side of things, and that is just the market and technical side of things. And if you can kind of isolate each one as a project, as a founder, then you're more able to essentially have greater success. Because one of the things that most people don't realize is, the failure rate for a business within the first 5 years, I believe it's like 90 to 95%. It's something that's very high.
Yeah, very high. Yep.
As far as tokens that get launched in crypto, the failure rate is actually 99 point, I think 7%. There was a study out there, which means the rate of success is way lower in crypto, which means you just need to have a little bit more thought, a little bit almost more patience in how you go out and roll out a token, a project into the market, because you have something there when it comes to a token that you don't in a typical brick and mortar business, right? In a brick and mortar business, you want users, you want foot traffic, and you want revenue. And then you have your budget that you have to keep track of. On a crypto project and a protocol, you have those things still, but then you have this added component, which is the monetary side of things with a token. And I often think that, for I don't think it has to do with bad intentions or anything in the space. I think it's just because it's just a new domain. Web3 is new, and a lot of these concepts that form around decentralization require some usage of a token.
Mm.
And thinking through all the principles of why somebody would want a token, when they would want to use a token, what will the user growth look like over time to uptake any additional supply? How do you go ahead and do capital formation in the early days for a project, and a token is a component of that. And so how do you marry all of these different things to have essentially what I like to say is the central bank, or the US Federal Reserve is a good example here, is have some sort of sense of price stability so you can build an economy or a business off of that protocol platform as well as that token.
So, Ben, we keep on saying there's so much to unpack here. You just gave a brief summary of what that model is, linking it a little bit to traditional businesses. I want you to back up a little bit and really start to describe. And you have a long history here in crypto. You've obviously been through the ups and downs of these different protocols. You've seen the ones that come out with good intentions, as you just said, and still flounder. I know I remember being invested in ones that I thought were really backed by good teams, and then investing in the token, and the token just never really, taking off, or being spiked when the market spiked, but never rebounding. So talk a little bit about the models and how you kind of arrived at this model today. What was your experience, and how did you arrive at it?
Well, so I guess this would be kind of trip back down memory lane here
a
for
little
me.
bit, for those who haven't read the 1,000 pieces.
Exactly, right? So I guess early on in my career, 10 years ago now, I first started to use that kind of Web 2 analogy for everything. So, oh, hey, the gaming industry is worth, however many trillions of dollars. And this project is going to be the base layer that runs all of these different games on top of it. And if right now the gaming industry had generates some $1 trillion of revenue, or whatever the number is, this project could capture 1%, right? The whole 1% trap that we hear a lot
Mm-hmm.
in terms of total addressable market. So that means this project must be worth $1 trillion, or I'm sorry, 1% of that. down the road. And there's so many just like complete oversteps there, like gaps in logic that
Hmm.
exist. And you know what? This is just how people get introduced to the space. So like even when I see it today, it's like, yeah, I've been there. I understand why you're making that analogy because Web3 is a completely different animal altogether. And so um, after doing that for a little bit, I started kind of writing my own analysis independently. I got picked up later on, and I started tracking over 50 different projects and tokens month to month. It even swelled up to almost 100 at one point. And I was just tearing my hair out because if anybody was around back then, this was well before a lot of the pieces of tech that we're familiar with now existed. It was like tracking every Telegram chat, how active it was,
Uh,
how many people were coming in, coming out, leaving, what was the Discord doing, watching the Twitter, how many likes it got. And we still use that to this day. And
yeah,
this is kind of why, right? Because that's all you had back then. And blogs, that was a big thing. I always read
yeah.
every project's blog every month. I was probably one of the few people that was coming back month after month. But
You were
um,
one of the 3 readers on those blog posts. I love it.
yeah, yeah. And there's like that Sunny was always sunny in Philadelphia meme where the guy has all these pictures on the wall and he's got, all these pins and he's drawn all these lines to form this thesis or opinion and he looks crazy eyed. Like that was me of like, hey, this project is so ready for success because look, it's got this, it's got that, it's got all these random points all lining up. And then of course you turn back, you come back a year later and that chart looks disastrous. Right?
Right.
It never formed a higher high. It's just continually just kind of going to that traditional down and to the right chart that we're all too familiar with when it comes to altcoins. And that, constant happening of even going back to my original thesis and looking back and being like, where was I wrong? And just trying to up my game. I I was forced to really just say like I'm just missing something. I'm completely missing the mark. And that's when I really pushed harder on data,
So
and that was where I think I found a lot of the gaps.
so you had this intuitive sense that these projects could have merit, right? I mean, as you said, there was a lot of discussion about the promise of what they offered, the market that they were addressing, if they could capture a percentage. And when you were looking at them, you thought, well, yes, I could see the value if it's a decentralized protocol able to deliver on the actual promise, but how do you actually value it? That was the gap. And so I think what you're saying is that you had all this analysis, you're pulling your hair out, you're aggregating from every single source that was available to you. And then, it didn't seem to have any reflection in price a year later when everything just tanked.
Pretty much. I had just dozens and dozens of pages of notes. I would listen to the live streams and take notes. And I had files and files of every project month after month that I could draw on.
Yeah.
And it was, even going back, it's like I almost feel sorry for myself because it's like I was tracking it and I felt so strongly or passionately about, the upgrades that were happening each and every time. And it never really materialized into anything. And I had to just sit back and be like, you know what? This is just taking so much time and I'm so wrong. Right? Like that
It's
was
good
like
for you to
the
admit that, right? To have that
yeah.
realization.
I had to just sit there and be like, dude, you're just so far off the mark. You just
Mm.
just give up. Right? Like
Oh
maybe this
man.
isn't for you. But
Well,
um I
so how did that turn into, okay, you have this realization, listen, I was so wrong. How did that turn into and translate into you starting to build your own models?
I wanted to find something more scalable. Because you know what? Tracking all those things wasn't working. So let's do something different. And that's when I started diving into the data and just trying to keep track of stats. And like almost don't even read so much about the updates anymore. Yeah, like kind of gloss over them. Don't worry about the Telegram chats anymore and following what the founder is saying every day. Like just, you know what? Just put that on the back burner. Look at some data and just start watching it, day after day, month over month, and look at the charts as they're happening to see if you can find anything. Um, I quickly ran into problems with that though, because
Mm,
I quickly was realizing, you know what, this is going to be scalable. I can do much more than 50 tokens. Um, and the problem was, as I'm talking to all these data providers at the time, was a lot of them didn't want to go into these new layer ones that were launching. They wanted essentially a little bit of Lindy, which is, they want to be around for a year and a half, 2 years. And back then, that was, you didn't see much of that.
yeah.
And for those that did exist, I could see the amount of users over time and transaction volume and count. And that was pretty much all the data that you could get back then. And if you did have access to that, heck, you did great. The explorers, like I had to essentially, because I'm not a coder. I did do some coding in my younger days, but I'm far from that now. And
Yeah.
I went ahead and just manually would track, on their explorers, like how many users or activities they would have, like, once a week. And that was how I kept track of this data, because historically those things just didn't really exist. And over time, I kind of saw some familiar patterns that started to emerge. Um, but the realization right there was that, as far as relying on a data provider, it was too expensive. Like, data's everywhere, and in order for in a company to go ahead and start extracting that data, ingesting it, storing it in their database, indexing it, and then computing metrics off of that is expensive. Like,
Yeah,
there's
I don't think
even
people even have any clue unless they've spent time how expensive it can be.
if you don't calculate it a metric efficiently, especially when it comes to Ethereum data, because there's just so much. Like,
Mm,
what could cost like $100 might cost you, thousands of dollars of just
right.
doing it incorrectly. Granted, you'd probably run out of credits before you finish the metric, but that's the point here, is that data is free, it's transparent, it's anybody can permissionly access it. But is it really, like, when we say free, what does that mean? It's not free, right? There's a
Right.
price to be paid to go ahead and compute it for what you want. And you also, it takes some time to build this railing for ingestion and database setup and indexing it all, and being able to calculate those metrics on a daily basis. Like, this is expensive. And this is a barrier to entry that I think exists in the market right now, and it will take time to bring this barrier down. I mean,
Yeah.
we have pretty significant costs associated with data, that I don't expect any clients, any listeners or readers to really fully grasp unless they've been there and done that. But
But did
stepping back, go
Yeah,
ahead, my
I
friend.
wanna point out something here because, we've had so many discussions offline about this, so it gives me a little bit more of a perspective to ask questions here. It's not just accessing the information, knowing how to curate it, knowing how to, source it, and efficiently, as you just mentioned. It's also knowing how to think about what is signal versus noise, how to think about how
Mhm.
do I organize it into metrics
Right,
that are informative. And
right.
so that's part of the modeling that you really went down that journey on. And you mentioned, I know we'll get to it in a minute about the three different legs on your token rating side. But I think you had this moment that you shared with me before about how you realized that everyone was sort of looking at these elements as they started to have the data available. Over the last couple of years, you've had data providers starting to come online. They're providing this information, but everyone's looking kind of in silos, right? You have people that are looking just on chain. You have people that just look at technical analysis. You have people that just look at fundamentals, and they all tell a bit of the story, but they don't tell the complete story. And then you brought more of a background from an economics perspective. So maybe just zone in on that and kind of share that, because I always found it interesting. I think the audience who's very interested in price signals would be interested why, what is that economic lens that was missing that you were able to provide as you started to build these metrics?
Sure. And before kind of get into, the monetary leg of everything, I think it might help to explain that first leg, which is the network side of things, which I mentioned. I was looking at users, the amount of users on some of these other L1s, as well as transaction activity. Um, I'm going to come back to that because
Mhm.
before I got to what to do with that data and kind of form a framework around how to think about it, um, I was I had a subscription with one provider, and they had some great data, and they still do to this day. And it gave me a custom dashboard. I could set up my own charts and manipulate them how I wanted to. And it was, at the time, it was the best kind of dashboarding experience you could have for what there was. And I made my stuff, and I felt all happy in the morning when I would log in, and I would feel like I'm, very powerful in understanding the markets that no one else is able to see this because it's expensive, right? Well, log in one morning, and on the left hand side, I see all these big VC names right in front of me, and I can just click on them. And all of a sudden, I have a different dashboard set up right in front of me.
Mm,
And it kind of looks similar. Like there's little differences, like different times. So instead of maybe 21-day moving average with a 7-day, it was maybe an 8 and with a 13 or something, like a fib
mm,
crossover setup. And I was like, okay, all right, interesting. There's some takeaways here that I can learn and use for my own knowledge. But for the most part, I'm looking at the right thing in my mind. I was like, all right, finally on to something. And then just later that day, I go on Twitter and I see one of those VCs just going all poetic on Twitter with this massive long thread and hitting on some of these stats. And I'm like, oh God, oh God, that's what I'm looking at. And no, that's not right.
mm.
And it was like, oh man, this to me was like, am I in a vaporware industry? This was like my existential crisis moment because I thought I finally had something, and I'm looking at their stuff right that morning, and eventually they found there was a bug and they closed it off, and that was that. But then afterwards, I see
Yeah.
that tweet, and I'm like, I kind of say it was like I found out that the emperor was standing there naked, so to speak.
I don't wanna
And
look at any of those VCs naked. That's horrifying. Absolutely horrifying.
yeah, I'm sorry to put that imagery out there.
Yeah.
But yeah, it was that moment where I kind of got really worried that I was completely in this industry that was just total essentially BS, selling
Mhm.
vaporware, and everybody was, it's almost like people knew it was vaporware and they were just trying to sell vaporware to each other. Note to Travis Kling's thread earlier this year, I believe, because he kind of hit on that premise really well. But that was the feeling I had. And so
Just to be clear, I don't think Travis Kling you were saying was promoting vaporware. I think you were suggesting that he was talking about the industry of trying to do that.
yeah, correct. And Travis is a really great guy. He is
Yes.
a beacon, I would say, in this industry. So if you don't follow his words, I would recommend that you follow him on Twitter and take what he says seriously, because
Yeah.
he's a vet. He's been through a lot of stuff that we can all learn from.
Sure.
But
Yep.
to yeah, so to get to that, it was kind of like my existential crisis where I had to like either essentially hang it up, or I had to like push through it. And because I had a salary attached to it, I pushed through it.
Yeah.
That was pretty much the deciding factor there.
Good incentive, good incentive, yes.
Right? Yeah, nothing higher level there, but just
Yeah.
just straight up dollars. And I was looking at the users, and I was trying to look at users. I overlaid that with price, and I did start to see something. It was like
Mm.
the first little glimmer that, what, there's something here with these network statistics. And so I went back to Metcalfe law, which that was a theory that a lot of individuals in crypto would always point to. So I went ahead and I did some deeper work on there. Masari at the time, they had a metric on their dashboard that did Metcalfe law for like every project,
And
and it
Ben,
was
just let me break in there. For those who perhaps are newer or unfamiliar, can you just describe very quickly what is Metcalfe law?
yes, Metcalfe law is, what, I might have a quick slide that I can use for this quick explanation, which is just what is the value of a communications network? Like, how should we think of it? And
Mhm.
Robert Metcalfe is the one that really put this to the forefront. and it was basically the amount of different connections that can be formed to create various unique um, node to node communications. Like that would be the value, and that value grows exponentially as more and more nodes get added to a network, right? So if you only have essentially a tin can with a wire to another tin can, what's the value of that network? It's really just right there. It's just two people communicating. But then as soon as you have five, right? Now you can have a lot more different connections that exist within that network, and so you kind of arrive at a value of 10 different connections. And then as you get to 12 in the image I have up here, it's 66 different connections. So you can see how it quickly starts to scale up. And so what Metcalfe did was he came up with this theory that the value of a network equals A, which essentially is just, I like to call it just this random value for overfitting a model
Mm,
multiplied by the amount of users squared. And you can change users squared to a different type of equation, but that's the general principle. And so it was a way to value a communications network. In crypto, at the end of the day, it is a communications network.
mhm,
It's a way to maintain consensus in a network. And consensus is a form of communication. And so as the state of the network changes, the consensus that everybody's agreeing upon at any given time is changing. And so we can think of it like that. Now, that A value is kind of where I took issue, and I'll come back to it
yeah.
because I'm sorry they had this Metcalfe value, and it was just all over the place. I think I remember XRP at the time; it was just like the value was nuts, and I just was like, why is this so off? Why is this so crazy? And I again, I just had to try to figure it out on my own. And
Yeah.
and really that kind of light bulb moment came about when I started thinking of transaction activity, transaction count, transaction volume, and of course, really thinking about what is a network doing, which at the end of the day, it's just putting ones and zeros in a block, and the size of the block is a constraint. And I don't mean constraint in a negative way, but it is a constraint in the network. And so if that exists, now you can that's the commodity, is the amount of space that's there. So
Mhm.
250 megabytes, like how much can you put in there? How many dollars does it cost to put each byte of data into that block? And that to me was a reflection of how much demand there was in the network at any given moment. And thinking of these communication networks like more like financial networks really helped kind of take that leap and push through that vaporware question, more so, and really dive into it, which was, look, do you have all these different users on the network? Okay, just because you have a ton of users that exist on a network at any given moment doesn't mean anybody wants to use it at any given moment.
Right, right.
So, what is it that defines it? And that's when you have a surge of activity, when all of those users are willing to pay a premium to use the network. Then it becomes a very valuable network because they have trade offs that they can make. There's substitutes that exist in the market. Like I can go ahead and Venmo you money instead of doing a peer to peer sending of money on a blockchain permissionless decentralized network. And so that trade off is expressed right there in terms of the amount of money I'm willing to spend to store that change of state of the network, right? So that's where I decided to take A, pull it out, put this demand value in there, and that became essentially my way to think about these networks more like kind of demand plus you have this amount of users, and then that would be the value of the network. And so looking at demand in that sense really opened things up a little bit for me. And then the users I had a big problem with because there's so many addresses, but then you also have all these dormant addresses. And
Mhm.
then also when you first rearrange the equation like that, these high activity and these moments when zeros and ones cost a lot of money, you see this valuation of the network go through the roof. But in reality, not many users can use the network anymore. So I
Hmm.
had to rethink that as well in the equation, which you have a certain, which is I call TPU, which is total potential users of the network at any given time. Like just because you got $10 in your wallet and maybe it costs you $5 to make a transaction, behaviorally speaking, are you going to make that transaction? Probably not, right? That's
Yeah,
too
right.
expensive. So where's that threshold? And that's some of the work that we've done, which is defining that threshold better. Where you know what, maybe it costs $1 and you want to go ahead and spend $10. Like, yeah, you're more
Hmm.
likely to use that. You will be likely to make that transaction, but if it's going to cost you $3, like, yeah, you're hesitant, right?
Sure.
The amount of users willing to do it drops. So in high activity moments, as demand starts to spike, your total potential users that would use the network drop. So that becomes like your top line. It's a way to essentially throttle that valuation a little bit. But then as A comes back down and demand comes back down, the amount of users that could use the network start to rise. And so
So
it's like a nice relationship that starts to
yeah,
exist.
I want to recap this for the listeners because there's so much good information there, but it can be a little dense. I think the first time you kind of hear it is that you kind of look this, everyone, maybe at the time they were talking about Metcalfe's law, this idea that all these nodes were growing on these networks. Isn't that fantastic? Aren't they more valuable? You peeled that back and said, well, wait a second. There's questions about what you're going to be doing on the network. It's not just that you have all the nodes. It's what are those thresholds from a price perspective that people are willing to pay to actually use the fundamental element of the network, which is the block space, right? If be it on Ethereum, be it on Bitcoin or any of these other networks for that matter. So then as you started to peel that back, you were looking at the actual equations, which I think led into what has eventually become this new model, which has sort of three separate elements: the monetary, the network, and the technicals. So my understanding is that these kind of all play into that demand side of it, as well as on the supply side, right? Because you do have the amount, as you said, there's a constraint around the amount of block space. Every
Hmm.
blockchain decides
Hmm.
how big the blocks are, how many bytes of information can be contained within a block.
Hmm.
So walk us through how you identified these three separate areas. What exactly is the model with these three separate areas in them?
Well, it just helps to also just think through like one scenario that's very common in the industry. And this is once I started to really almost buy into my own way of thinking and kind of form my own form of analysis around projects that I it was kind of my style. Like I finally could say to myself, like, this is the way that I look at it. It was
Mhm.
kind of the first time it was different than I think I was just used to borrowing everybody else's. Um, and it was really like mainnet launches or like major upgrades on throughput or the cost to do a transaction on a network. And if you always saw those moments, there was like kind of like the buy the rumor, sell the news. But then if you went ahead and went like multiple months before that moment and then multiple months after that moment, it's like you could see something wasn't right.
Mm.
It, it was supposed to go up. Like this is supposed to be a good thing, and it wasn't. But if we go thinking through that equation a minute, and you think about what you just did to that A value, that demand value, you just cut it in half. And what does that do to the valuation of the network? It cuts it in half. So right there, it was like, do you actually need to drop the cost to use your network? Like, are you going to be able to bring that amount of users to your network to offset that drop in demand? Or are you going to run into issues? Like, that should be a question that engineers should be asking themselves before they go ahead and implement it. I mean, just having it in your back pocket for when you need it is probably
Mhm.
more useful than just kind of iterating and just moving the project forward sometimes. Um, so that that right there helped me think about some things. And then you asked what were some of the models that went in there. You know, demand that A value that I kind of reconfigured there is one of them that goes into it and tracking that over time and then forming essentially a model that can look at that strength or weakness over time, almost relative to itself. Um, Users are, of course, the way that we look at that. It's a little bit different, but it's very helpful in looking at that over time, especially the growth. And a lot of these things, a lot of these models, they all have to do with essentially the rate of change of things, because that really does matter when it's the convexity of any variable that really matters when it comes to markets. But um, then there's another one that's diversity, and it's a little bit more abstract, but and it was kind of added in later, so I don't really want to get into it. But it's just that kind of really forms this thinking around network, that first leg of the stool, if you will. And it really wasn't until, oh boy, late 2020, early 2021, where I started to form that second leg of the monetary side of things, which all, if you think of the network side as the demand side of the equation, this was the supply side of the equation coming up.
Okay. Oh, a little bit of a liquid break.
Yep. Yep.
So,
Sorry, ranting
how
there.
just I know you got a lot there to unpack from elements of it. How long would you say you've actually been working on developing this thinking, this model? What you can say is now called the token rating. But it's built on a series of models and understandings.
I I would say I really started to kind of like the network side of things, especially in 2000, late 2017, 2018.
Mm,
That's when I kind of started having my own form of analysis and thinking. And then as really DeFi summer 2020 and the whole notion around TVL, and what that meant. And of course, the discussion that TVL really isn't that important when it comes to how, like, the worth of a token. It was like, why? Like, all of a sudden, I had to ask the question why, and diving into why the TVL metric just didn't work when it came
mhm,
to evaluating the market cap of a project or understanding price movements for a token. That's when I needed to better understand, like, why it wasn't working. And at the time, the best concept that I could come up with was the from my background, because I'm a commodity economist by training, was really quantity theory of money,
mhm,
QTM, and thinking of the amount of tokens in circulation because of the way that at the time, especially DeFi summer, a lot of projects were emitting tokens in exchange for people's capital. It was a great way for a new project to bootstrap capital early on in its launches. Of course, Compound really broke the model there. And then you saw Sushi and Uniswap do those things as well. And it was a way to bootstrap liquidity to protocols that needed capital and liquidity to
mhm,
function. And so in return, they gave additional yield in a speculative asset, which was their own native asset. And then, of course, what did the price of those things do over time? They dropped like a rock, but their TVL was very strong and
mm,
growing in some instances. And so the question was really why. And everyone's dumping on each other, and it's just you just want to sell the token. And then, of course, at the time there was this whole DApp token thesis that was regaining popularity because it was popular before then too. Back early when everyone's trying to figure out how to think of these things, that protocol thesis was one way, DApp token thesis was another. Uh, but it was really that kind of, again, that same chart, right? Everything's going
mhm,
down and to the right. That made me wonder, like, what's going on here. And I started to try to think of TVL a little bit differently. And that's when I started exploring quantity theory of money as it relates to crypto. And the only examples I could find at the time, it was all basically changing the units of that equation. So
mm,
you would basically be moving freely between the amount of Bitcoin, let's say, that were in circulation, and then you're moving to US dollars and volume. And in my head, I'm thinking you can't change from that unit to that unit seamlessly within an equation. It didn't make sense. You have to keep it natively to one. So either you move the units of Bitcoin in circulations to dollars, but then all of a sudden that doesn't make sense because it's very responsive to the price, but you're trying to find the price of per Bitcoin. So it's like you start to
right.
get into these issues. that you can't really get out of. And
The issue being that if you priced it in, let's say, dollars versus the native token of the network.
so QTM, for example, quantity theory of money, that equation is really all in US dollars, and it's
Mhm,
the amount of dollars in circulation. It's how frequently are those dollars moving? What is the productivity of the economy in which those dollars are being emitted from? And then what is the average price of things in that economy,
mhm.
right? Because if you know the average price of things, then you can basically figure out like how productive the economy is. And it's just that equation can be rearranged in so many different ways, and it should be working no matter which way you form it. And it's all got similar units of account. So with Bitcoin, you couldn't really do that. So if we think about it in just Bitcoin units, you have, this equation, which maybe I'll help and bring it up on
Yeah, maybe that'll be helpful. Yeah.
bring it up on my screen here. Um, let's see. I'm gonna have to cycle through the slides. It looks like to get there. Um, but it's really P equals MV over Q.
Mhm,
I pretty much have it memorized. Let's see. Right there. So on the left hand side, in the people here in the middle of the room is an analogy I use to explain how this really works in a simple way. But P is the price level, right? That's like your CPI, for example,
mhm,
for the US economy. Q is the output of the economy. GDP is what we tend to use in that slot, is equal to M, which is the amount of dollars in circulation, multiplied by V, which is how frequently are those dollars moving around the economy. And so you can rearrange this in many different ways and it works. But for Bitcoin, it's like, okay, you got the amount of Bitcoin in circulation, 19 million or whatever it is, 20. And then you have essentially the amount of those, like how frequently each Bitcoin is moving around the economy, or the network, sorry, in any given day or year, however you want to measure that. And that should be equal to essentially the price level of the Bitcoin economy. What is that?
mhm,
Right? And just that question pops in your head right away. And then Q, what is the productivity? Like, how do you measure that? And right there, like that's that asking that question. And then I applied it to Ethereum later on. I really started to evolve the way I was thinking about these networks, because all of a sudden I'm realizing, you know what? Like there is a transaction cost that exists on the network. And for Ethereum, it's kind of like you got a set amount of 21,000 gas just to send ETH from one wallet to another. And a swap generally costs about 100,000 to 120, 130,000 units of gas to kind of compute the transaction. uh, so there like kind of is this price level that exists. And so
mhm,
thinking of the economy over time, because swaps got more efficient, believe it or not, like the average unit of gas that required to make that transaction would go down. And of course, in a bull run, it got fully inflated because nobody cared about how efficient a swap was anymore, because everybody was making money, which has to do with essentially how productive things were on the network, because people just didn't care. Um, and then as the bear market happened, you saw suddenly a return to efficiency of of how of how low in terms of gas was being spent. So what that did also was realize, you know what? Early on Ethereum, your your price level or average for amount of gas used, 21,000 gas units to send ETH from one wallet to another, was your primary transaction. And then you had ERC20 tokens and moving those tokens on the network, which was more gas, right? So now your price level of the Ethereum network just went up because the basket of what is normal on the Ethereum network just changed in
mhm,
terms of how expensive the average activity was. And then you had NFTs, right? And that standard created even more expensive transactions. Then you had swaps come into place. Then you had lending and borrowing and providing liquidity. And now you have For example, Pendle here, it's like 400 to 900,000 units of gas to make a transaction. So we went from 21,000 to almost a million units of gas in a transaction. So that's how you can think about how the price level of an economy changes. Just like a loaf of bread costs you a nickel back in the day, and now it costs you $4 or something,
Mhm.
right? Same sort of principle here. Um, and so Q is also unique because it's like how productive is the network, and that's a lengthy discussion that we should probably avoid for
Yeah,
today.
there's a lot to unpack there, isn't there?
Um, but then you get to M, and that's when things start to open up as it relates to TVL. But it was just asking, what does this equation mean in crypto? Because that allowed me to start thinking of the financial networks actually as a Web3 economy,
Mm,
an isolated economy. It was emitting its own token. Right? People were able to set up businesses on it. People had general price levels to go ahead and transact every day within that economy, right? They had a supply. There was a certain movement of that native currency taking place. And at various points in time, the economy was more productive than other times. And it was like, okay, this might work. And for me, it wasn't until our team made the decision to actually break down TVL. We were like, you know what? Let's just give this a try. And dumbly enough, we went ahead and we started with Ethereum, which going back in time was probably not the wisest
well,
move.
if you could recommend it, what would you have started with instead of Ethereum?
Um, Probably an
Ripple?
alternative layer one that has less
And it
transactions, less wallets,
right, less volume, less
something that's EVM.
yeah.
Like doing Solana is a nightmare for data providers.
Mhm.
So, but at the other end of things, it's like everybody's got Ethereum data. That's
Mm,
widely
easier to
available as
access,
well.
yeah.
It is, and as far as
I
TVL, there really wasn't much outside of Ethereum either at the time. But if you were doing it today, I would try to find an alternative layer one EVM. Start small, take
well,
small bites.
Ben, I do have a little bit of a sidecar question here. You have these moments where you're looking at the information and it just doesn't seem to connect, right? You're seeing,
Mhm.
VCs tell you, "Oh, everything looks amazing," and you're looking at the data saying, "No, it isn't. It's, emperor has no clothes." You have people saying, "Here's the TVL, here's the network values for growth," and yet they don't seem to resonate with price. So you start to go down the path of trying to understand using some of your background, as you mentioned, as an economist by training, to try and understand what are the other factors. But why do you think the market is so satisfied with existing metrics? It feels like they study the data that they have in the way that's given to them rather than asking the questions that you have, which is how do if they're not connecting, there's something wrong with the model needs to change.
Why? Because people are making money, or at least people think people are making money, and the current. I mean, the way that I would almost view it, it's we see the meme coin craze going on. Like, really, what is that? And a lot of people think it's like giving the middle finger to VCs. Right? I'm not going to buy into your low float, high FDV, which is fully diluted value, which is like you only
Mhm.
release a little amount of tokens into circulation, and there's a ton of tokens that will be coming into circulation. So the market cap looks very low because it's only measuring the amount of tokens that are in circulation. So it's a
Mhm.
deceptive practice, and it has to do with kind of stocks and how you evaluate market cap over there. But kind of besides the point there, it's just that when you look at meme coins, you can kind of accomplish the same thing. And don't no one should pretend VCs aren't in that game. Like they absolutely are. Like there's fully, these liquid VC funds that exist for a reason. And they figured out a way. I don't mean they as like this was their master plan. It's just they're involved in it, right? One of the reasons that it's very attractive is they kind of just abstracted away the need for a platform, the need for a protocol, the need for a founder, essentially,
Mhm.
right? This is why marketing gigs are in hot demand right now because that becomes like the main person behind building a project for something like that.
So really the incentives have been set up or they've evolved to a point where it's just so profitable for them to operate using these vanity metrics to describe growth and success rather than trying to put in the hard work of understanding how do we define and develop sustainable protocols?
Mm. Yeah, so like think about earlier where I was mentioning I had to go through Telegram, I had to go through Discord, I had to go through Twitter, I had to track socials over time, likes, followers, I remember at the time people were tracking the amount of messages in a Telegram chat every day over time.
Mhm.
And we see even Reddit channels. Like this is why those things are popular, is because back in that day and age, if you will, uh, that's really all you had, and people still track that to this day. I think who's the provider? Is it the Tie? I forget, but there's a data provider out there who their main thing is providing these socials. That's their
Mm.
unique niche in the market, and they do a great job of it. And a lot of people buy into that, right? A lot of people want attention on Twitter. What's the cost of that? How effective is that? How many likes am I getting? How many, all those things, right? There's a complete industry is built around growing those sorts of things. And I think partially, one, it's just borrowed metrics from the old age
Mhm.
of kind of how was, and essentially using that to this current time frame to kind of bolster metrics and what people kind of still look at to this day. I don't think there's been any discussion on really how integral some of these fundamental principles are to how that would drive price. Like there is a reason the Federal Reserve says I want price stability and I want to maximize employment. Those are my two mandates and nothing else. If you had a project say that today, it's like different ball game, right? Like we want
Yeah.
not create price
Not
stability
a
for a stable coin.
Right, right, right. I was gonna say stable coins is like, oh yeah, duh. We understand that. That's exactly their purpose. You're saying for a project to have a token for a network that allows you to have stable or consistent economic growth within that network.
Yeah. If you're a builder, one of the first questions you ask is where am I going to build?
Mhm.
What's going to be around in a year? What's going to have enough tooling, enough users? Do I want to go build in the middle of New York City, or do I want to build in the middle of Montana or something?
Yeah,
Well, where are my users going to be? Where's the liquidity?
right.
Is am I going to be good in New York City? Are the laws good? Is everybody kind of on the same page and forming consensus around these things? Is the security good? And and someone's going to rob my store if I open up shop over here. Like,
Mhm.
no, my streets are secure. The contracts are pretty well tested. Like these are the questions that developers have to ask nowadays in order to have success. But there's still questions that they don't ask, which is kind of the monetary side of things.
Well, so I guess there's a question that comes to mind, and I even came to mind when you and I were having our early discussions about this, which is Ben, this sounds like tokenomics, right? You're talking about supply. You mentioned some metrics like FDV. How is this different from just what the people that are supposedly studying tokenomics? How do you distinguish between the two if someone asks you that question? Because I think I've come to my own realization or my own answer, but I'm interested how you think about that.
Sure, sure. So the way that tokenomics is thrown around, I think of it as allocation tables. I think of it as the vesting schedule or the distribution of tokens over time, as well as what's kind of the emission of the supply over time look like. And to me, that is for anybody who's taken part in private investing, that's just like your cap table essentially. That yes, and there's going to be stocks that get vested over time and that get distributed out. I don't know why we had to create tokenomics for all those concepts, right? They already exist in
Mm,
this day and age. Um, but what what we started to see a lot of was incentives to go ahead and lock up tokens to a protocol. And the thinking was that if you're a true believer of the project and you're in it for the long haul, you're going to lock your tokens up for 4 years. They didn't do so well. And the incentive there was just lock them up and you'll get a higher, more tokens over time per
right. Some
year.
kind of bonus. Yeah. Right.
And if you only lock it up for a short period of time, you get kind of a lower APY of future supply. And you know what? That didn't work. But why does a project do that? Why did it have any sort of success? And asking that question allowed us to think about in game design, they call it sinkholes.
Mm-hmm.
Um, and I call them inflationary sinks when I speak to clients. And it's just if you think about money, dollars, right, and as money starts to get spent more and more in economy and it heats up, it creates inflation, and it allows vendors, businesses to raise prices because there's just so much demand. Um, but you create a really great yield on a very long duration asset, and people start locking up those dollars. They're not spending as much money anymore. Right? We go back to this whole how much is that money moving around in an economy equation. You're trying to reduce that, tamp it down. So if you're asking people to lock up tokens to a protocol, you're tamping down inflation. And inflation for a token is essentially the price of the token relative to everything else going
Mm-hmm.
down a lot. It has less purchasing power. So seeing that design come up time and time again as tokens kind of get launched and all that token gets distributed into the economy, um, and kind of like why people are thinking about that and realizing like, look, people are only locking it up for more tokens for at a later date.
Yeah. I wanted to say what came to mind as you were describing this was that there's a sort of this tension that exists when you're talking about providing in what we consider like the real world economies where you put your money, your cash into an account, you're getting an interest back. There's an alternative investment, which is spending it on something or investing it in other assets or other ventures that could grow the economy and grow your size of it. With the model you were talking about from a tokenomics perspective, it's basically put it into this one sinkhole without looking at anything that would grow the economy for that network. It feels like it's missing part of that, right? There has to be that tension between the opportunities that exist for that to become more valuable and for that network to become more valuable. So that way you're saying, hey, listen, we're going to offer you 4%, 5%. And the person says, well, wait a second, I can invest it over here at 10% to grow the economy. I'll have a bigger share of the economy. I'm going to do that instead. But if
Mhm,
the best thing is just to lock it
mhm.
up, your economy is not going to grow. Am I thinking about that correctly?
Absolutely. And the way that we started to, from a data perspective, to start to drive into that big question mark, like how can we tell folks that are creating their own economies and projects and tokens, like how do we better explain this of like why you actually should not do such a thing? And if
Mm,
you're pretending to do that, this is why it could be, hurt you at a later date. And the way that we broke it down was trying to better define why a token gets locked up and how it gets locked up. And the way that we can think of it, and this is again borrowed from quantity theory of money, which was the explanation that that variable M, which relates to money supply, not all money supply is created equal. Like you have cash in your pocket. That is as liquid as it gets. It's right there. You can make a payment right there in front of you. If you have it in your savings account and you don't have a debit card or credit card attached to it, you need to transact it and then you can eventually spend it. And that might take some time. That's a little bit less liquid
mhm,
and it might be earning a little bit of interest. So there's a little bit of a higher form of how you're holding that money in terms of higher form of usage. That because the bank's going to be using it, by the way, for trying to make its profit.
Mhm.
You might lock it up into a 3 month, 6 month, 9 month CD, right? This deposit is going to give you even higher forms of interest, and it's more illiquid. And then you can get down into 30 years, right? And that takes a very long time for that to become liquid again.
Yeah.
And thinking of money like that changed as supply to crypto allowed me to start thinking a little bit differently because if you lock up your tokens on a DEX pool, for instance, is it really an inflationary sinkhole? No, it's fully liquid. People can swap right through that pool and essentially move, and that's very liquid tokens that exist in the market at any given time. Same thing with like your wallet. Like that's highly liquid. You can move it right out of your wallet the next moment. Sure, behaviorally speaking, if it hasn't moved in 1 year, the chances are that it's going to move tomorrow are very low versus it hasn't moved in 7 days. Chances that it might move on the eighth day are much higher. Behaviorally speaking, you can break down a wallet like that, but on a global kind of macro view, if it's in your wallet, it's highly liquid. It's in a
Mhm.
DEX pool, it's still
Yeah.
highly liquid, um, but it's a little bit less. And then if you stake it to a platform and you earn some yield, that's less liquid and it's a little bit higher form of usage because you're earning some yield from the network itself. And then you can get into, say, lending. As you lend that money out, it's not liquid necessarily. There has an action that has to happen for that to become liquid in the market. And so all of these DeFi primitives essentially exist. It's just how do you label them in the form of how liquid they are
Yeah.
relative to the economy. So I have a chart on my screen, and this is what we did for Ethereum. This chart looks like it's Solana, but we broke down this token supply for Ethereum over time.
Mhm.
And we classified them into those various buckets, like I mentioned. We call it, this is kind of similar to dollars. M2 is a certain money supply that many of us use. So I defined it, anything M0 is defined as just tokens that are in a wallet, just a plain old EOA wallet. M1, tokens that are sitting in a smart contract but highly liquid. And this might be a liquid staking token contract because that liquid staking token is fully liquid, but the native asset is locked up into a smart contract. Index pool, again, same thing. M2, it can be made liquid through some type of action that would be required. And that would be non-liquid form of staking in lending as well. And this would be essentially M2, higher form of usage than M1 and M0, and also less liquid. And then M3, it's essentially not liquid because it's being held investing or there's some sort of time lock component to it. And then it would require some sort of smart contract interaction for it to be made liquid. And so we broke supply down into these various buckets. We looked at it over time. And if we, I don't know if I can go back to that prior um, equation, but it was the P equals,
P
supply
equals NV
multiplied by
over Q.
velocity
Yep.
over Q. And so supply multiplied by velocity, like that's what we got to hone in on because if your supply went from a illiquid state to a more liquid state, and then the velocity of that token started to rise, that is very hot inflation. And we went ahead, we looked at what happened to price each time that happened, and it was a hit. And this was like an
Mm.
aha moment, like, whoa, okay, back up here, guys. This actually works. Are you for real? That was like kind of the reaction here. Like, this is too good to be true. Let's go
So
on to the next price one, right?
I,
And
I,
then
wa- I want to make sure that I'm clear on this. It's not just that you're seeing an unlock in supply. It's how liquid that supply is that's really seeing whether or not that price movement is up or down. I'm guessing in all the cases there you saw it move down, it tanked.
it did. And oftentimes you would have an unlock of tokens in some protocol take place and it became fully liquid Mind you, price didn't move right away.
Mm.
Okay, and so that was like we even saw that with the COVID era, right? There was a ton of money in the economy, and everyone's like, "Where's inflation? Why isn't it here yet? It's going to be huge when it comes." It's like, guys, the money hasn't moved yet. Once it starts moving, the economy starts to understand, and the price level begins to change. And that was an analogy that we can get into later if you want, but to help understand like why price levels change in an economy, it's not until the money starts to move around does everything start to essentially find a new equilibrium. And that's
Mm.
the key differing factor is once we saw velocity start to kick, that's when price just began to tank. And that was it was the aha moment, and that allowed us to really sit back and be like, you know what, this monetary thing has something to it. Let's start tracking these metrics. And what we started to see was monetary as that leg in the stool. It could be reshaping in the background and changing the conditions of things, and it will not translate to price. You have to have a catalyst for that price. And that was where the network and also the technical side of that stool come into play. And
Mm.
those act as catalysts. And what the monetary side of things would do, it would essentially allow that catalyst to run hotter, longer, or hotter to the downside for longer periods of time. And that was when we were kind of thinking to ourselves, you know what? This monetary thing is really all about beta in the marketplace. Like if the market's going to rise because correlation across the market, which is extremely high,
Mhm.
if everything's moving up together in tandem, why does one move faster than the other? Everything else equal. And it's because the monetary conditions are primed for that move. And this is where, price acceleration, we call this like how inelastic a supply is, which is what supply shock is all about. And for Bitcoin, we call it the hodl rate, for example.
Mhm.
When there's not a lot of tokens that have moved in a long period of time, and then you have the reduction of new tokens into the market, we call that the supply shock. But really, it's how inelastic things are getting when there's a 1 unit change in demand, price moves greater than that. And
Yeah.
that's as a trader, I shouldn't say trader, but as an investor or running a portfolio, like you want exposure to beta as much as possible. And that's what really the token ratings is really all about is better understanding beta in the marketplace.
I like that framing of it because obviously we talk about these with sort of this view towards these great new technologies and the change that they can provide, but there's no escaping that there is a price element to it. There's an investment to it. You're being asked to put your money, your hard-earned cash security on the line to participate in these networks. And so that actually has a different element to it in terms of the expectations from people joining into crypto. And then they're asking themselves, is there a way in which I can make that grow more quickly? So I want to kind of recap here from a understanding perspective because we've covered so much ground already. When you talk about this token rating system, it's finding beta and understanding those price movements and where they may be outsized, right? But there's these foundational elements or concepts that it sounds like you've arrived on through all of this analysis and thinking, right?
Mhm.
You've talked just right now about the M1 and M2 and M3 and M0 rather. So you have four different ways of locking up tokens or being fully liquid, and sort of the usage and the behavior of that is going to impact the velocity, which is the second concept of how those tokens would be used within that network and within that economy. And then you have obviously the supply side of it, which is going to be related to that, right? With the amount that's in there. And then, of course, locked across those four different areas. And then how it's actually being used in that economy. And then you have the size and value of the network. Are there other core elements that you think I didn't summarize there that are impactful that someone would need to understand or just really try and bring to mind when they're starting to look at the token rating system?
Yeah, it when you start thinking of crypto and tokens and projects, protocols, layer ones, layer twos, etc., kind of with this framework, you view them more as an economy in and of themselves. And what that means is like all these kind of old concepts and theories that have already been developed. Like you don't have to like reinvent the wheel here. You take it off the shelf and you apply it to crypto. And I always tell people, whatever you did prior to entering crypto, just bring that experience in. You're gonna find a way to relate it. And as far as like a way of thinking for an economist, like when you start thinking of an economy, I always forget this guy's name, but um, he really drove down this concept that the creation of credit was mostly responsible to essentially an expansion in the economy. So if we're thinking about crypto at large here, and we're thinking about it as an economy, and we have participants in the population and banking accounts, they can create credit. Like there are DeFi primitives on layer one networks that allow
Mhm.
people to go ahead and create credit. And what happens? Well, you create credit, you get an expansion of your economy. And like kind of that was like the last one as far as the monetary side of things that we didn't really cover is that we
Mhm.
actually track, how leveraged up or like what are the credit conditions that exist for a layer one project. And that right there tells you like, look, there's a ton of collateral and it's not tapped. When you think about what the legs are here for a growth cycle for a project, like you want that to be low early on. You see price rising, you expect that network, that economy to get levered up. And as it starts to top out, you see credit conditions get topped out as well. Solana, got way ahead of itself earlier this year with its credit conditions. It was hitting one on our ratings right near its top. And if you went ahead and you saw what was going on, it's just frankly like the lending networks, they could have opened up a lot of their vehicles to more capital and they didn't. They had a
Mm.
capital constraint that was existing on Solana. There was a possibility, it could have kept going, possibly, if more collateral was allowed to be deposited into, I think it was Camino was one of them, so they had all these caps in place and the rates were going insane. People just really couldn't borrow any more money. It was probably good that they didn't raise caps because it allowed Solana to kind of reset itself and likely get ready for another strong run higher. But that understanding right there, when you start looking at it as an economy, it starts to make a little bit more sense of why certain projects might run hotter than others. It's because
Mhm.
of that, right? Those primitives exist to create greater expansionary moments for a layer one network.
So I think you've given a really good foundation for what the token rating is, the key concepts that are driving the thinking behind the elements of it and the framework. I think next I want to get into actually breaking down the model, getting more into the specifics of it and see what other insights we have, as well as applying it. I mean, you mentioned a couple of examples around Solana, looking at Ethereum, looking at Solana, and being able to unpack it and give the audience a flavor for what this actually looks like. Hey guys, hope you enjoyed part one of my discussion with Ben Lilly. Be sure to like and subscribe to the channel. Find out when part two is coming out. Ciao, ciao.